Hello and welcome to this conversation on BloombergQuint. The Reserve Bank of India cut interest rates by 25 basis points today. There are a lot of people out there saying that this was expected, and yes, indeed, over the last month or so, a lot of people have started to expect a 25 basis point cut. But the only research house which can truly claim that this was expected is Bank of America Merrill Lynch, because despite various flip-flops in the RBI stance, Bank of America Merrill Lynch has held on to a 25 basis point cut in August call since pretty much the start of the year. Joining me to talk about that call, Jayesh, Mehta, Country Treasurer of Bank of America Merrill Lynch, and Indranil, Sengupta, Chief India Economist at the bank as well. Firstly, it's unusual, but I'll have to say congratulations because this really was a call that you all had on to. Let me start, and both of you can jump in as you want. I want to understand whether the conviction behind the August rate call has sort of played out in data, and the analysis that you got from the RBI. Is that the scenario that you were anticipating when you held on to that August call for months now?
I would say maybe August date was more of Indranil's thing. Mine was not a date, but a theme, right? So, and I still believe in the theme that we will still see further rate cuts. I think structurally, the inflation in DM world is down because of various innovation, and I think structurally the inflation in India, I think global part, definitely if you just remove oil and food, and Modi government has taken a great job on the food side, and of course rain has also helped. And I think oil is a long story. It's not looking anywhere going above 70 for maybe few years. So where is the inflation scare? So I think that is more of generic inflation call, more than timing call. But Indranil's timing was more on August.
Why August, Indranil? Why did you? In every report I saw that August call.
Okay, we thought that. This is when they would get clarity on the rains, the RBI, MPC, and therefore if the rains were normal, it would help them to cut rates. So that was why we talked of August. But in general, this is a big macro theme of poor growth and low inflation that is playing out. And that's unlikely to end anytime soon. And imported inflation is also coming off. As Jayesh said, oil prices are coming off now. The dollar is weakening. So from a variety of perspectives, we think that there is scope for at least one more rate cut in December.
And I'll come to that in a minute, but just in terms of the inflation story. So yes, rains have been good. We've had 2 good rains, but did anyone anticipate this kind of sort of disinflation or deflation in food prices? And again, I go back to a point that Michael Patra made in the last monetary policy minutes, and he asked that question with an exclamation mark, saying, "Does anybody expect this to be the new normal?" Do we expect this to be the new normal?
No, we don't. Nobody expects this to be the new normal. I think the issue is whether you get the direction of inflation right in your forecast. See, inflation always, surprises on the up, it surprises on the down. But the issue here was of direction. So I think what we were saying is that inflation is on a downward trajectory. Now, whether it goes to 3 or whether it goes to 2 or whether it goes to 1, that essentially depends on, there are always overruns. But the point is that, when you are in a world where growth is weak, you have it's fairly logical to expect that inflation too should be low.
I would just add one more thing. So we went through 2 years of drought, right? And so there are 2 parts to food inflation. One is, of course, your rains, right? And second is hoarding. And I think that hoarding part is like kind of, they've killed it. The government has done a great job on hoarding side of it. So I think that inflation, so earlier, and the hoarding side kind of, when you have a shortfall, they can actually really escalate big time. So they kept a good control on that. So I think from that perspective, and I see no reason why they will not keep it. As we go to 2019 election, they will keep a good list of it. Even if next year we have rains problem, they will make sure that we have enough import to supplement the inflation expectation.
Jayesh, from a more market perspective, the market has been whipsawed this year, right? I don't know whether it's not being able to read inflation or not being able to read the RBI or both, but you had that February change, then you had the April reverse repo hike, which a lot of people said was almost a stealth hike. Now, you have a rate cut, but not a change in stance. It's been quite a roller coaster.
I think that's why, like thematically, yes, we are looking at downtrend. Would have policy challenges. That's why one of the reason I like today's policy quite well as compared to the other one. That is, okay, now we are data dependent. So, okay, you take a call what your inflation expectation is, and then trend accordingly. But even if you have a falling inflation situation, but if RBI gives X number, you tend to follow that, and even if you don't tend to follow, the market's going to follow that. So you definitely has to follow that, right? So I think now, of course, it's data dependent. So it is what actual data prints comes in. So today is also policy. They never said that like if data is soft, they will still have room. So it's a question of whether or what is the data which we are expecting going forward.
But they didn't change their stance. So some of us were asking whether this is slightly conflicting. You're cutting rates, not changing stance, you're pulling out liquidity, and I'll come to a deeper discussion on liquidity. But some of those are slightly conflicting in themselves, no?
I don't think anyone expected them to change the
That would have been too much. I think a bond rally would have been
very, very recently. So I think, when you're neutral, technically you can cut rates. That's fine.
So you don't think that there's any...
You don't think that, they're going to change stance.
Okay. Then on the liquidity side, now, so they said that they will continue to pull out liquidity. And they said that they're looking for more tools as well. Is that in keeping with what you think liquidity management should look like?
See, I think there is a large part of the liquidity, quote unquote, that we see is that of the money market.
Yeah.
But if you see overall liquidity, which is money supply, that is running at 6-7%. And naturally, if your total money supply is running at 6-7%, your loan growth is constrained at 5-6%, and that is keeping interest rates high. So at some stage, I think right now maybe there are flows and this is a slack season, but at some stage the RBI will clearly have to inject liquidity at a far higher rate, because clearly if your loan growth is constrained to single digits, you're not going to see recovery. You're not going to see lending rates come off beyond a point.
But you're convinced that the loan growth issue is linked to liquidity and not, the various other
cap,
issues.
Right? If the liabilities of the banking system are capped, then the assets cannot grow beyond a point. So, at some stage, you have to have more liquidity, which will pull down lending rates, and that therefore, you will see loan growth.
Maybe you can explain in detail, right? So basically what Indranil
He's
is
saying
trying
that
to say
M3
is like, because if you look at it, the cash which has not gone to the bank, but that's anyway part of your overall money supply, right? So overall net supply, except for whatever intervention they have done, which is maybe roughly around 2 lakh crore, but now. But still last month it was just 1 lakh crore, right? So roughly around 2 lakh crore is what they have infused this year. They need to infuse 6%, 7% additional money supply. So that's a challenge, and I think I still have another thought is like at some point of time one need to cap repo and reverse repo, cap in the sense not literally cap, but I think 50,000 crores to 1 lakh crore is what you should manage through repo. The rest has to be used other tools, maybe MSS, maybe whatever. But because that, if you look at 2 years back or 1 year back, 1.5 year back, while we were cutting rates, we were not giving liquidity, right? And March 16, we had 230,000 crore systemic shortfall. Where is the transmission? There's no way transmission can happen, right? I think, and the same thing right now is the surplus absorption. Of course, the challenge this time around is a little bit additional because you don't know how much is getting remonetized. Yeah. But now with out of 17.5, maybe 15.5 got remonetized, which today Dr. Viralachia was saying that is kind of stabilizing. But maybe they might have to still see a month. But that's when the real thing will come, whether that is permanent or whether it is temporary.
This money market liquidity though, so I think there was a question asked, although not answered, that there's a lot of liquidity in the money markets going into corporate bonds, etc. Those yields have fallen to a point.
I love
Go ahead,
so it's like so I think since mid-90s or early 90s, we've been chasing bond market, liquidity, corporate bond market, blah, 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 and all that. So we did a good job. I've been involved in most of the committees.
And you've been there on every panel discussion on deepening of the corporate bond market.
We did a good job from, say, maybe mid-90s to early 2004, 5 or mid-2000, 2005 in terms of back-end system. DMAT, seamless trading, settlement, blah, blah, blah. Fantastic job. And I can tell you, like, our government securities platform is world-class. I think it beats a lot of developed countries, right? But what we didn't really do is the financial market thing. So in this post-2005, the theme was, my theme, and I had kind of used to say, I used to joke, it is like, at that point of time, 8, 9, 10, and then I moved it to 7, 8, 9. I think wherever, when people start talking about corporate bond market liquidity, and I used to say, okay, fine, let's go to GSEC. Is it really that liquid? Let's go to equities market, remove FPIs. Is it really liquid? No. The answer is, when you have a structure where, your GSEC is, say, 7%, your corporate bond is 8%, and, you have a sovereign bank deposit at 9%, right? Why would anybody buy anything else? And if you look at globally, right, wherever the financial market is developed, it's like deposit rates is the lowest, right, followed by government bonds, followed by corporate bonds. I think this is demonetization plus the lack of credit demand kind of has pushed this, where today, after a long time, our deposit rates are much lower than the GSEC. And that's where people are now looking for alternatives. So that's where people are looking at mutual funds, any other asset. But 8, 9, 10 at one point of time, I used to say sometimes 7, 8, 9, depending. But trajectory was that, right? Why would anybody do anything else? And 10% as an absolute return, 9 to 10% as an absolute return is a great return. So why would you, and risk-free, sovereign bank, right? So why would you do anything else? So that's why it's now coming to, which is what you wanted, financial savings, people wanting to come into that, and that is where the money is moving. But yes, because it happened so sudden, and suddenly that's why people are getting so jubilant about.
So the mispricing of risk and all that, you don't believe that that's anything?
No, I don't think so. I think, so I can't comment on equity market valuation, but I think somebody else also was, I think in terms of mutual funds, their flagship funds at least, I would say, they're very conscious on the credit side. So, typically, and even I would say the historical spreads are not so tight. It's not as the lowest spread over GSEC on the AAA paper.
It's not.
It's not.
Okay.
Plus, there is a seasonal element. Around this time, corporate bonds always soft.
I have one question to you. We didn't hear anything from the RBI on it, but I know you've written about it in the past. We still don't have that currency number. We still don't know. In fact, one of your calls had said that they will build in the dividend that they're paying to the government. We don't know when. We don't know when they're paying it. We don't know if they're going to delay it. We don't have any clue of what the currency numbers are. Does that make a difference to you?
Well, yes. We estimate that number to be around 60,000 crore.
60,000 crore is the dividend.
Dividend.
Okay.
Because that seems to be the amount of currency which did not come back.
But that's the special. You're saying there's
That's
a special dividend
away
from over and above. Okay.
So we are. I mean, I think by the time the RBI's annual report is released, I presume they will have to have that number, because otherwise, how do you close the books?
Exactly.
So let us see what happens.
Okay. Now let me just move to the call ahead and wrap up the conversation. So December, you're saying. Yeah. Now explain to me how you see it playing out till December. Does inflation remain between 2 to 3%? What is your projection?
Yeah, I think inflation will go up from here. The base effects will reverse, so inflation should cross, maybe 4.5 towards the end of the year. But the average inflation for the year is going to be 3.7%.
Okay.
So I think that even if inflation goes to 4.5%, that is no cause for concern, because your inflation target range is 2 to 6%, and given that growth is going to remain weak, I think there is sufficient room for the RBI to cut once more. I think long run inflation is probably 6.5%. Our policy rate goes to 5.75%, which is effectively a negative real rate of 75 basis points, which is fine. In the last down cycle, Bimal Jalan had run a negative real rate of around 50 basis points. Okay. Here the problem is that when we first started cutting, the first 50 basis points was a ghost cut, because it wasn't accompanied by liquidity. So naturally you have to cut a bit more on this side. So I would say that if inflation goes to around 4.5% over the second half of the year, which is what we expect, there is ample scope for the RBI to cut, because you're still 1.5 percentage points below your max target.
So you are even more dovish perhaps on longer term inflation, and also
I think my inflation trajectory is, as I said, like we have two things, right? Food and oil for India, and then the global factor, the global inflation. And I think most of the developed world is fighting for getting inflation and is struggling to get inflation. And they have, of course, reduced their average expectation on inflation. So yes, me and Indranil always have this favorite debate. So he talks about average, long-term average of 6.5%, and I said, like, yeah, but then innovation came only recently. So we don't have enough data. I think technology, innovation, all of them came so recently, and that's been very disruptive. And of course, the lifestyle changes, millennial lifestyle changes. So at some point of time, it's not only India, it's the EM world need to recast and recalibrate their inflation to downward side in near future.
But is there a fair amount of comfort that now in this cycle, we will be able to retain rates at a relatively low rate for some time? I mean, we haven't been able to do that, right? Because we always had that volatility in inflation. Now, assuming some of the structural factors that you talked about are playing out, do you think we'll have a slightly, longer stretch of low rates in the economy?
I think, right now growth is likely to remain weak. So it's hard to see rates going up, over the next 1-2 years. So I think we'll probably get into a long pause, because as long as growth is this weak, it's hard to see inflation meaningfully go up.
Your calls on that? Same
thing. So I genuinely feel like, yeah, it's very difficult to time out. That's Indranil does that. December he says, but I said, yeah, structurally I'm looking at much lower number, much lower overall rate. Maybe why stop at quarter? Maybe another 0.5%, but timing is going to be difficult.
Okay. That's the conversation, gentlemen. Thank you so much for joining us. Appreciate this. Thanks for watching BloombergQuint. You can catch this conversation and the story around it on BloombergQuint.com as well.